Good morning, everyone. We shall wait for a couple of minutes for some participants to join. A very good morning to everyone. I'm Bhumika on behalf of Cashrich. Welcome you all to the webinar on psychology of SIP. Here are a few points to note before we start the webinar. Kindly rename yourself in the format first name space last name. Participants can post their questions in the chat section of the Zoom meeting. The speaker should take up the questions in the last 15 minutes of the webinar. It is my pleasure to introduce Mr. Amit Grover, National Lead Training, SDFC AMC Limited, as our esteemed speaker of the webinar. Mr. Amit Grover is a mechanical engineer, MBA, and CFA Level 3 candidate with 16 years of experience in financial services, spread across wealth management, training, learning, and development. He has conducted 1,200 plus sessions covering equity, fixed income, behavior finance, international investing, and personal finance. A warm welcome to you, sir. I now invite my colleague, Mr. Hiren, to give a brief introduction to CashRich and take the conversation forward.
Good morning. Thank you, Bhumika. So good morning, everyone. Thank you, Bhumika. And thanks, Mr. Amit, for joining this session. So we are glad to arrange this session on SIP with HDFC Mutual Fund. The idea behind this is to share the power of SIP and also at the same time share the power of SIP top-up. These are challenging times, but SIP is always given us the best result. So the idea is to share the nuances of SIP investments with Mr. Amit Grover. So we'll over to you, Mr. Amit Grover. Just a second, there would be a short video on CashRich SIP top-up, and then you can begin the session. Thank you, everyone, for joining the session. Mr. Amit, you can begin the session. Thank you.
Thank you, Hirenji. Second. So good morning, all participants. Today we'll talk about something which is very simple, which is SIP. It's one of the best wealth creating tool. Unfortunately, it's also the most misunderstood investment idea. I will talk about the big advantages of SIP, and I also talk about the big money mistakes which generally investors do in the entire journey of wealth creation through SIPs. So let's start with a very basic thing. We all of us start our day with reading newspapers or some magazines or basically switching on the TV and figuring it out what's happening in the world. And something economics is something which all of us hear as a front place news that oil prices are moving up, US is increasing interest rates, India is increasing interest rates, inflation is very high. And obviously, with all this information, we become very anxious to figure out what's happening in the market. Let us understand the biggest challenge, I'm very sure, which is troubling all of us in a very big way. We have been hearing a lot of news that US is basically increasing interest rates, and possibly even India will start increasing interest rates by high percentage. And everybody is anxious about it. What if a lot of rate hikes happen? What will happen to Indian stock markets and how will economy behave in general? Let me just rewind things for you just to explain you how typically things looked in 2003 to 2008 period. So 2003 to 2008, US increased interest rates 17 times. The Fed increased interest rates 17 times. So obviously, if you had this information in 2003, that Fed is going to increase interest rate 17 times, most likely you would have stayed away from equity markets. Interestingly, from 2003 to 2007, this period when actually Fed increased interest rates by 17 times, India showed the best returns from an equity perspective. Indian equity markets gave 41% CAGR during these 4 years. So the interesting thought is that if you would have got worried of what is happening to US interest rate, unfortunately, you would have lost the best equity returns which India could have offered. So the first thing, as a logical SIP investor, you should not worry about what's happening with macros in general. Yes, it's good to know about it, but the most important thing which you have to understand about equity is as basic as this. What is equity in very simple terms? Equity means investing into businesses, as simple as that. And which are these businesses we talk about on a daily basis? All the expenditure which you do right from morning till late evening, okay, all the expenditure which you do, okay, is basically a profit for somebody else. Like you get up in the morning, you brush your teeth, it's Colgate or Pepsodent. You have atta, it's ITC. You wash your hands with soap, it's Dettol. You have Maggie, it's Nestle. You go to a bank, it's HDFC, ICICI, Kotak, SBI. You take a two-wheeler, it's TVS, Bajaj, or a Hero. You take a car, it's Maruti, Mahindra, or Tata Motors. You paint your wall, okay? It's Asian Paints, Berger. You put cement over there, it's basically ACC, Ultratech Cement. You fall sick, it's Sun Pharma, Dr. Reddy's, Ipca Laboratories. Basically anything and everything what you're spending your money on. You take a metro, it's L&T. You use a mobile phone technology, it's Airtel or Vodafone. Uh, or Reliance Jio. You put petrol in your car, it's ONGC, or maybe HPCL, BPCL, or Reliance Industries. So basically, anything and everything which you are using in the entire day and every expense you do basically is a profit for somebody else. And the beauty is that all these companies, okay, are in front of us. So equity in very simple terms means investing into businesses, and mutual funds are a very simple investment vehicle where technically we understand that we don't have the time nor energy nor the knowledge to figure out which companies are doing well from a universe of so many companies. That's why you, me, and all of us outsource it to an equity mutual fund manager who invests on our behalf. There's a fund manager and there are a team of analysts who basically do good fundamental research and try to find out good stocks, a very well diversified portfolio to create wealth from a long term perspective. It's as simple as that. Now, the first basic question which you have to ask yourself is that why does equity does well from a long term perspective? And what drives equity markets? Actually, what drives equity markets in a very simple term is earnings, profits. And I put a very simple charts just to explain you how the trajectory of profit looks like. If you look at the trajectory, you will look at the long-term trajectory of earnings and profits is always upwards. So what drives equity markets from a long-term perspective is profits, earnings, and as long as the earnings are moving up from a long-term perspective, equity market generally rises from a long-term perspective. It's as simple as that. All we have to do is basically understand the dynamics of equity and stay invested, ignoring all the macro noise which we keep on hearing on a daily basis. Now, let's try to understand further. It's very simple to invest in equity mutual funds, but let me talk about the challenges which we all of us face on a daily basis. First challenge is, okay, I know a lot of investors who understand the benefits of equity and equity mutual funds, but the biggest challenge what they face on a daily basis is actually to save money. And saving is not something which is very easy. It's actually honestly very difficult. And let me try to explain this from a psychological perspective. There was a very interesting experiment done on kids. ये छोटे बच्चों पे एक्सपेरिमेंट किया गया था 1980s में. A very interesting social experiment. Kids, उनके सामने एक मीठी चीज रखी गई थी which is called as marshmallow, and the kids were told that you wait for 15 minutes and you will get two marshmallows. 15 मिनट रुक जाओ, आपको दो marshmallow मिलेंगे, otherwise you can just have one marshmallow. Okay, mathematically, logically, rationally, it makes sense for all the kids to wait for 15 minutes and to get two marshmallows. But data showed something very different. uh, Almost 70% of the kids were not able to wait for 15 minutes because the temptation of having it right now was much more higher than waiting for 15 minutes and get two marshmallows. Actually, this marshmallow test happens with us on a daily basis. The beauty is, yes, we all of us know that we have to save money for our children's higher education. We need to save money for our retirement, which is a zero income life. All of us most likely will get retired at the age of 50, 55, or 60. We are in service industry, and in unlike manufacturing, okay, most of us are in service industry. Life actually, the working life gets over at 55, 60. So what happens? And we all know that life, we are going to live longer. There's going to be approximately 15, 20, 30 years or 35 years of zero income life. The problem is that in spite of knowing that we have to save and invest for our long term goals, the temptation of short term is extremely high. When you see your friends, relatives, neighbors, colleagues, okay, going for a vacation, take the fancy transport, okay, buy a new car, have an amazing home decor, it's very difficult to actually save and invest. And that's why psychology says that having a metrics where you can forcefully save and invest is the best way of investing. And that's where SIP comes into picture, because it forcefully takes money from your account on a monthly basis, on a disciplined basis. Discipline is something which we all of us lack, unfortunately. The idea is SIP brings discipline, SIP brings forced saving and investing, and it takes the money from your account and it forcefully invests from a long term perspective. One more problem, which is unfortunately a part of a human brain, is that we cannot visualize things beyond 5 years. Okay, it's not humanly possible to think about life in general beyond 5 years. If I also ask you, what are your long term plans? You might just tell me your long term plans, which is like 2 years, 3 years, 4 years, 5 years down the line. Nothing beyond that. It's difficult to imagine the world. And that's why it's generally seen people think about their retirement or their zero income life only at the age of 50 and 55. Unfortunately, it's very late by then. Ideally, one should start saving and investing at a very young, early age, in spite of knowing that your retirement is going to be around 15, 20, 25, 30 years down the line. Okay, we have to actually explain us, and it's very difficult to do it, okay, because our minds are not designed that way. Now, I just talked about how long we're going to live, but now I'll explain this with data. If you look at India in general, in the periods of 1960, this is data from World Bank, the average mortality or the average life of human beings in general was around 42 years. Okay, this is India specific data. Okay, this is not global data, it's India specific. The average mortality of Indians was 42 years. In 1980, it was around 55 years. Okay, a good improvement. But as we speak right now, the average mortality is around 70 years. And this is only going to increase. The Western countries, obviously, a lot of people live till the age of 85, 90. And soon, even India will move towards that place. So imagine that you're getting retired at the age of 55, 60, and a big long retirement, okay, of around 15, 20, 25, 30 years of zero income life. We have to start saving and investing at a very young age. Now, another problem is that when we are doing our investment planning, we also forget something called as inflation. The idea is that the value of goods and services are only going to increase. Okay, a simple example. If I just recollect, I did my engineering. My annual fees was 5,000 rupees. Today, I pay my son's fees. He's in class fifth. The fees is around 1 lakh rupee. This is called as inflation. Second thing which is also happening, which we unfortunately tend to forget, is that our standard of living is only increasing. Okay, most of us, I'm sure, if the AC is not working for even half an hour during night time, we might feel anxious about it. But let's try to recollect the world 10 years back, when most of us maybe were not having ACs, but still, okay, we were able to sleep extremely well. But what happens is standard of living, once you get used to a particular standard of living, it's very difficult to go back. Our standard of livings are also very increasing gradually year by year. Okay, so two things why we have to save and invest a lot of money, because first is inflation, and second is also predominantly our standard of living is also increasing. Now, we also have to understand it's very nice to copy the West, and Indians generally love to copy what's happening across the world. We are exposed to Netflix, Amazon Prime, and we also get inspired in terms of what these people are doing. And we see generally in the West people spending a lot of money. Okay, and we also feel, you know what, life, we only get one life, and we should also spend and enjoy our life. But one thing we have to understand that things are slightly different as we compared with the West. In West, you have unemployment benefits. A lot of people over there get pensions over there. Over there, even the inflation is not very high. Plus, they get medical benefits. Unfortunately, none of these things are actually available in India. No medical benefits, no defined pension. Inflation in our country is also very high, and we don't get any unemployment benefits. So honestly, we have to take care of ourselves. okay, of our retirement, of our goals, our long-term objectives on our own. Nobody else is going to help us. We have to take ownership of our long-term goals. Now, uh, I'm very sure, in fact, people talk about whenever we start equity sessions today or market session every day, okay, people talk about that markets are volatile and these are uncertain times. And this is how typically a session starts. And I'll give you a very interesting example of how to look at fear in general. Okay. The lady on the left is basically, her name is Madame Curie. She was the first woman to get a Nobel Prize. In fact, a first woman to get Nobel Prize in two different fields. And she says something very interesting, which I love. And she says that the only way to deal with fear is to understand fear first. So let's try to understand fear. We all of us are very fearful whenever we look at our stock portfolios or our portfolios. When we see them, our equity mutual funds portfolio is down 10, 15, 20%. It makes us feel extremely anxious. So let's try to understand what is Madame Curie trying to say. Okay, let us try to understand the fear of equity market. And this is a very interesting chart for me. Okay, this chart basically in simple terms explains by what percentage does equity market corrects or falls every year. This chart is not telling you by what are the returns in equity market every year. It just tells you by what percentage does market corrects every year. And it is very important to look at history. History gives us all the answers. This chart, this is the 30-year chart, and this chart explains it very beautifully. This chart explains that by what percentage market is correcting every year, or the falls which happen from the highest point to the lowest point. You will realize that a 10% fall in equity market is a given. It happens practically every year. There's not even a single year where markets have not corrected by 10%. Even a 15-20% fall is also very normal. Okay, once in 2 years you can see a 20% fall. Even a 30% fall in equity market happens practically every year. So the first thing one has to understand as a good equity mutual fund investor from a long term perspective is that it is given that markets will fall every year. It is the nature of equity markets and you can't do anything about it. Second thing is, as an SIP investor, you should actually celebrate whenever market falls. I give you a very classic example. Indians love gold, okay? And whenever gold prices correct, okay, Indians buy a lot of gold. And the reason why they buy gold when actually the prices of gold are down, because they think very differently. Because they try to do a simple maths that in the same amount of money, I can buy more grams of gold. Because when the price of gold comes down, you can buy more grams of gold. The similar thing or the similar psychology can be used for an SIP investor. Whenever markets correct, you actually get more units. Because what happens is that with every correction, you are able to get the more units of an equity mutual fund. So ideally, as equity SIP mutual fund investor, we are actually in the business of accumulating more units. The more units we accumulate, the better for us because in the long term, it is NAV into number of units. So the objective of a good mutual fund investor is to celebrate when markets correct because every time markets correct, he should or she should feel happy about it that they are able to accumulate more units in terms of wealth creation. Now, also second problem is that people also tend to not understand investments in a good way. Today, the world is actually filled with negative and a bad news. Okay, in fact, there is nothing called as good news. There is hardly any good news. News, the idea of news is that okay, accumulate everything which is bad happening in the world and just put it in a bunch of a paper, and we get completely anxious in terms of what is happening. Okay, in the current world and we look at the current scenario like a microscope. We take a microscope and anything which is small looks extremely big. Ideally, one has to understand that bad news is actually good news for us because bad news actually gets very good prices for us. So markets have corrected, it actually gives us good prices. So whenever there is bad news, actually it's good because it gives us good prices. That's the first rule which we have to understand. And the second thing which we have to understand is that we don't have to sit with a microscope trying to figure out what's happening currently because it doesn't matter. Whatever news you're reading right now, honestly, will get expired in few days or few months or maximum 1 year. You have to sit with a telescope. And what is a telescope? You have to look at from a long-term perspective. When I say long-term perspective, you have to look at the stars and you have to look at the stars in such a way using a telescope that you can look at the long-term picture right now. The beauty is that equity gives amazing long-term returns. The world was uncertain, is uncertain, and will always be uncertain. I will just ask all of you to do a homework. Just look at the news of 2001, 2002, 2003, you will realize that the world was always uncertain. India was always uncertain. Uncertainty was always there. But the bottom line is that businesses make returns, businesses make profit, and equity makes amazing returns from a long term perspective. Now, I will tell you what are the big challenges which I have seen. Okay, history always repeats, and that's why I love this world called as Kal, Aaj or Kal. Hindi in past is also called as Kal. Aane wala future is also called as Kal. And I'll tell you the big money mistakes which I have generally seen investors do in the last 17, 80 years of my experience. So I will talk about the last 27 years and I'll talk about my personal experience of last 17 years. The interesting point is I started my career somewhere in 2005, 2004, 5, 6, 7, 8. During these 5 years, equity was doing exceedingly well. SIP was doing exceedingly well, were giving amazing returns. So everybody was saying that, you know what, SIP is the best tool, SIP is the best tool. Everybody wanted to put all their money into equity mutual funds, okay, and do SIPs. Unfortunately, in 2008, markets corrected because of global financial crisis, and suddenly your SIP returns, okay, became zero. Your 5 year SIP returns became zero. And I saw so many investors actually stopping their SIPs because there was a lot of negativity in the market, okay, and SIP 5 year SIP returns became zero. I saw many investors stopping their SIPs. The same thing happened actually in 2014. 2014, 15, 16, 17, 18, 19, 20. For 6 years, SIP was doing decently well. A lot of investors wanted to start their SIPs and they were doing their SIPs. Okay. And people were creating good wealth. Unfortunately, COVID happened and markets corrected. At the bottom of March 2020, the 6 years SIP returns practically became zero. And I saw a lot of investors stopping their SIPs. One has to understand that this is the nature of equity market. Okay, the beauty is that soon after 2008, markets bounced back in 2009 and everything became perfectly fine. The same thing happened in March 2020 also, when everybody was anxious about markets. Okay, and suddenly you saw your 6 years 3 months SIP becoming zero. In 2020, post the fall, markets bounced back. Even in 2021, markets bounced back and everything was fine. The unfortunate point is that whenever SIP gives low to negative returns, we have seen, unfortunately, investors stopping their SIPs, okay, or redeeming their money, which is actually the worst thing which they can do. All you have to do is basically continue with your SIP and stay invested. I will talk about a fund, okay, a very interesting fund. It's called HDFC FlexiCap Fund. This fund was launched in 1995. Okay, and this fund has given phenomenal returns. Obviously, it started with the NAV of 10. Today, the NAV is almost touching 1,000. Okay, it's 997. The beauty is that in last 28 years of the existence of the fund, many big events have taken place. We saw dot-com bubble. We saw basically a COVID crisis. We saw a global financial crisis, and basically thousands of events which happened on a daily basis. In spite of that, the fund generated amazing returns. Past performance is not a guarantee of future returns. Okay, it is just as an example to show that the idea is that equity mutual funds and SIPs give you amazing returns from a long-term perspective. One has to understand that ups and downs is the nature of equity markets, and you cannot do anything about it. That's the nature of equity market. Also, I'll also give you examples of generally I've seen people timing the market. Timing the market is the actually I would say it's a sin in markets because time and again it's been shown that time in the market is more important than timing the market. And this is one classic example to help you understand that why timing the market is a very futile activity. On 18th May 2009, I know basically a lot of investors were not invested in equity markets. They all were anxious of what will happen to election results. The interesting point is in the morning of 18th May 2009, where everybody was anxious and nobody knew who would come, when the morning the counting took place, everybody realized that UPA 2 will come into power. Markets gave two upper circuits. Upper circuits means basically a 10% rise in equity markets in the Nifty, and two upper circuits took place. The interesting point is that majority of the investors unfortunately missed this opportunity and they missed those 18% return in one day. Now, it's always said that there are few days, few months, and few years which are very important and they give you most of the returns. And it's very difficult to know which are those few days, few months, or few years. And that's why it's always said stay invested. Time in the market is more important than timing in the market. All you have to do is stay invested, continue your long term SIPs, and do nothing. And that's how generally investors create wealth from a long-term perspective. Now, which are the SIPs which you should do, or which are the options you should do? I'm not recommending you any funds. Since I belong to HDFC Mutual Funds, I'm just giving you examples of HDFC, but I'm very sure the partner whom with you are dealing with will actually recommend you the best funds which are most suitable from your risk appetite. Now, the interesting point is that SIPs is a concept. Okay, SIP doesn't mean only equity. You can do an SIP in equity, in debt funds, in a balanced fund, which are called basically hybrid funds. You can also do SIPs into global funds also. So if you want to do SIP for something from a safe perspective, like an RD, okay, not exactly an RD, but a substitute to an RD for your short-term goals, you can do an SIP into a short-term fund, ultra short-term fund, okay, or a liquid fund also. For first-time investors, maybe you can do SIPs because this is the first time you're investing. Maybe you can do SIPs into basically which are hybrid funds, like a balanced advantage fund or a aggressive equity and hybrid fund. You can also do an SIP into world funds. You can also do SIP into gold. Okay. The beauty of doing SIP into gold is that there are no making charges, no impurities. Okay. And you don't have to worry about storage costs, theft, locker charges, and anything. Okay. The beauty is that it gives you gold kind of returns over a longer period of time. And obviously, for creating wealth from a long-term perspective, you can do SIP into large cap, mid cap, flexi cap, small cap, based on your risk appetite. They can help you create amazing amount of wealth from a long-term perspective. And now I'll come to the last problem. Okay, I've generally seen that people talking about, you know what, SIP is for retail people. I'm a HNI. Okay, we think that SIP is such a basic product. I want something very complicated. And I'll give you a very interesting example of something called as Dettol versus Savlon. Okay, I'm sure all of us have got Dettol in our homes, and when we apply Dettol, it hurts a lot. Okay, on the other hand, Savlon, an equally amazing product, unfortunately, a lot of us don't use it because when you apply Savlon, it doesn't hurt you much. So a simple thought which goes to our brain is that if it is not hurting, that means it's not useful. And since Dettol hurts a lot, we think it's very useful. It's actually killing the germs. And that's why our brains are designed to think that to actually create wealth, we have to do something very complicated. We don't have to do anything complicated. We have to do something which is very basic, which is like an equity mutual fund SIP. Okay, just keep on investing on a monthly basis. As your salary increases, as your income increases, keep on increasing your SIP amount. SIP top up is an amazing tool. It just automates the entire process. That you know that your salary is going to increase by 5, 10, 15%. Just put a SIP top up of the similar amount, and it automatically increases the SIP every year, and it helps you create more wealth. So SIP is for retail people. It's for middle class people, it's for HNIs, it's for super HNI. Basically, SIP is for everyone. SIP is not only for one class of people, it's basically for everyone. It's a way of life in terms of wealth creation. Lastly, I'll tell you the fundamental problem in terms of what is the biggest problem, why people are not able to understand the wealth creation of SIP. If I ask you what is 6 plus 6 plus 6 plus 6, within a fraction of a second, you can give me answer 24. But if I tell you what is 6 into 6 into 6 into 6, honestly, it's very difficult to calculate. A human brain cannot understand the power of exponential. I've just done a simple maths to explain to you how you can make amazing returns. Okay, but what you need is time. So let's say if you do a simple 5,000 rupees SIP, okay, and you start at the age of 35, the corpus what you make, assuming 12% return, the corpus what you make, okay, at the age of 60, after 25 years is 94 lakhs, approximately 95 lakhs be, okay, approximately. Now you will say, wow, it makes great sense to start an SIP, but right now it's I don't have much money. I have to spend money on various things. I will start my SIP at the age of 40. Now you might think intuitively that what difference a 5 years can make. You will realize that because of 5 years, actually now your corpus at the age of 60 is around 45 or 49 or 50 lakh rupees basically. Your corpus has become approximately 50% lower. So what happens by a delay of 5 years, your corpus reduces by almost 50%. Now you make this 45 as 40 as 45. Again, your corpus comes down by 50%. Again, 45, you make it 50. What you end up making is only 11 lakhs. And this is the power of compounding or the power of time. The reason why majority of the investors, unfortunately, are not able to create wealth because they don't understand the hero in the entire story is actually time. The more time you give to your investments, the bigger the wealth you create. Now, I'm just hoping and wishing that there are some young investors over here. So instead of age 35, you start at the age of 30. That 95 lakhs actually becomes almost 2 crores. And if somebody at the age of 30, instead of that, they start at the age of 25, that basically 2 crores becomes 4 crores. So the magic actually is predominantly by something called as time. Time is the entire hero. Unfortunately, we have all the knowledge, intellect, degrees, MBA, and all the possible degrees in the world. The only thing what we don't understand that what is the hero on the entire story is actually time. We have to just give time to our SIPs and stay invested, and that's how we create wealth. These returns are assuming 12% returns. Obviously, markets don't go in a straight line. It is just for to explain to you how time creates wealth from a long-term perspective. Lastly, I will just uh, give a very simple and honest advice over here. Okay, because what happens is that unfortunately, a human brain is not designed for investing because it's perpetually anxious by what's happening in the world. And I'll try to give you a very interesting story. It's not it's obviously a story, but it's actually amazing research done by Fidelity. Fidelity is a globally well-renowned mutual fund asset management company. They were doing the research to figure out which are the investors who actually created wealth in their funds. And they wrote letters to all their clients who stayed invested in the entire journey. What they realized, okay, after doing the research, that all the investors, or in fact, majority of the investors actually who created wealth from a long-term perspective and stayed invested, but those investors who had died, okay, and their children were not aware about this investment. Since they had died and their children were not aware, they happened to make amazing amount of wealth. And Fidelity said in their research report that the only way to create wealth is to do nothing. Okay, what do I mean by doing nothing? Just do your SIP and do nothing. Just keep on doing your SIP. Keep on increasing your SIP amount as your income increases and do nothing. And that's the secret mantra of creating wealth. Doing something is actually the worst thing which you can do to your portfolio. Not doing anything and staying invested is the best thing which you can do to your portfolio. That's how you can create wealth for yourself and for your family. With this, I'll end the session, and I'm happy to answer any questions which we have from our clients. Thank you. Clients, if you have any questions, you can please put in the chat box and we'll be happy to answer your question. So, Mr. Dheeraj is asking a question that is the world more volatile than it was, right? Wanted, okay, is the world more volatile or uncertain? Perfect. Different SIPs, index funds, normal funds, perfectly fine. Can you advise for the current market double SIP values? Okay, I'll try to answer these questions which I have got received as of now. The first thing is world is not more volatile or uncertain right now, and that's why reading history is extremely important. Let me take you to the world from 1997 onwards. Okay, I can go even to the past of two prime ministers getting assassinated and 1991 economic crisis, and and basically, okay, we had three prime ministers like VP Singh, Devi Gowda, IK Gujral. Okay, a lot of uncertainty from the third front. Okay, but I'll start from 1997 onwards. In 1997, we had Asian crisis. Okay, the world panicked because of that. In 1998, India did something called as Pokhran test, and India got many sanctions because of that. 1999, we had something called as the Kargil war, which took place. Then at the same time, there was something called as Y2K. Everybody believed that the computers will just shut. Everybody was extremely anxious. 2000 dot-com bubble took place. Okay. Then 2001, there was basically a September 11, which took place, and it created chaos in the entire world. Then US-Iraq war took place. 2002 Godra incident took place. Okay, 2004 BJP government, the Vajpayee government lost by just one vote. Markets panicked completely. 2005, 6, 7, markets were doing well, but there was a lot of fear of inflation in general. 2008 global financial crisis took place. 2009 recession happened in the entire world. Markets were extremely anxious. 2010, 11, there was European debt crisis. Okay, it was a lot of worry that European big countries like Portugal, Italy, Greece, Spain, these countries will default. Okay, then US was it was something called 2014, 2013. There was something called as taper tantrum. US was talking about reducing the money supply, which they had printed. Markets were extremely anxious. Then 2014, there was some ray of hope when NDA BJP came into power. But then we had a lot of news in the markets about non-performing assets. Every time you read a newspaper or switch on the TV, you would realize that somebody was talking about some bank having big NPAs, ICICI, HDFC, all the PSU banks, big amount of NPAs were coming out because Raghuram Rajan at that time had told all the banks to show all their NPAs. And every day, what we were seeing is that big companies are showing NPAs, banks are showing NPAs. Okay. And at the same time, that anxiety went away. Then we had something called as demonetization. Very anxious moment, very uncertain times. When that period got over, then we had something called as ILFS crisis, which took place in the country. Then we had DHFL and typically NBFC crisis. Then we saw COVID, and then we saw basically some credit crisis. Then Yes Bank crisis. Then India-China challenge. Okay, it's just completed 2 years. The India-China problem which we faced on the border. Then 2021 we had second wave, and it was a very horrible wave, very uncertain. And then 2022 started, and Russian crisis, and now Fed increasing interest rates. Now the fundamental question, Dheeraj, to you is: tell me a period where world was certain. World was uncertain, is uncertain, and world will always be uncertain. Equity market is investing into businesses. Businesses make money, used to make money, are making money, and will always make money. All you have to do is stay invested and understand we stay in a world which was always uncertain. Today the world seems more uncertain because today you are much more aware. Ideally, the world seemed less uncertain in the past because we hardly had any information. We have moved from a world from Doordarshan to basically 1,000 channels, 1,000 news channels, and the job of a news channel is to make you feel uncertain and anxious perpetually. So it doesn't. Honestly, the world was always uncertain. There's nothing which has changed. Okay. Second question is, should I increase my SIP? It's very simple question. Honestly, it's not a difficult question. If you have more money, increase your SIP amount. So basically, you don't have to wait for the markets to increase your SIP. SIP is a concept. If you earn 100 rupees and if your expenditure is 50 rupees, 50 rupees should go in SIP to create wealth from a long-term perspective. If you can invest more, save more, keep on doing, increase your SIP amount. You don't have to ask anyone to increase your SIP. As your income increases, SIP amount should increase. Somebody is asking, should I do an SIP in an index fund? Yes, you can do it, but what you will get is only benchmark returns. Basically, there are active mutual funds and they have generated good amount of alpha. I'm not promising that amazing alpha will always be generated. Alpha means basically outperforming the market. I would suggest that you can have a combination of active and passive, but active funds have done a phenomenal job in terms of creating wealth. Just look at the history of the funds and their track record. They have done phenomenal job. But yes, you can maybe, if in case you believe more in passives, you can start your SIP in an index fund also. Do you think crypto is basically honestly, I don't invest in crypto. It's not that I'm anything against crypto. My logic is very simple of investments. If I don't understand something, I don't invest into it. And I've tried my level best to understand a lot about crypto. Unfortunately, I've not understood crypto. Crypto for me is not an asset class also, because an asset class is something which has to generate cash flows. There has to be earnings. Okay, for that, like gold is an asset, real estate is an asset class. It generates rent. Equity is an asset class because it generates earnings. Okay, fixed income is an asset class. It gives you interest. Honestly, I don't think crypto gives you any cash flows. So basically, you can call it whatever you want. I would not recommend crypto in any way. But if you want to invest some amount of your money for entertainment, that's your money, that's your choice. But don't keep it your part of your financial planning. Okay, let gold, equity, debt, mutual funds be part of your financial planning. Crypto is not part of your should not be part of your financial planning. You must have felt that I didn't spoke about real estate. Your first house, the house where I'm staying, is not an investment. It's just a place to stay. So basically, have your home for stability, okay, for peace of mind, but let the other money go into equity mutual fund, debt mutual funds, hybrid mutual funds, little bit into gold, and that's how typically you should plan. Do a systematic SIP, do SIP top-ups, and create wealth for yourself and for your family. Okay. Okay, so on what perspective does fund managers select stocks? Uh, see, it's very basic. Okay, basically, we all know that to even okay, whenever we buy anything, I'm sure when you're booking a movie ticket, or whether you are buying a laptop, or whether you are going for a foreign vacation, or whether you're going for a domestic vacation, anything which you are buying, you basically do your research. What is research? You look at quality, you look at price, and based on that, you try to find the best thing which is suitable for you. We know there are so many stocks in the market. A fund manager, there's a fund manager, and he has a team of analysts. There's a banking analyst, pharma analyst, auto analyst, and various analysts. Together, they look at the company's balance sheet, their annual reports, their profitability, their management, how the future will look like for the sector, what are the valuations of the company. And based on together discussion and analysis, a fund manager tries to build a good portfolio, which is very is rightly valued. It is a good company from a long-term perspective. That's how they try to find good companies which can create wealth from a long-term perspective. That's what their job is. And this is so basically it's not like playing in the darts, randomly picking stock. It's basically a well-researched company, a well-researched organization. Basically, it's their duty, okay, to find well-researched good stocks with a team of analysts. They are very extremely well qualified. They've been in markets for a long period of time. They are well connected. They do fundamental research. They even visit companies. They even talk to management very frequently to figure out, okay, in terms of whether it's a good investment or not, and that's how they build their portfolios. Uh, how do you select large cap, mid cap, and small cap? Your core portfolio should be large cap, followed by a little bit of mid cap, and followed by a little bit of small cap. Okay, your core is always large, big companies. So ideally, when you're building your portfolios, or maybe you can have a multi-cap fund or a flexi cap fund. Like I just gave you an example of HDFC flexi cap. It has large cap, mid cap, and small cap, all three of them. Basically, there are various categories. Generally, I've seen investors moving towards small caps when markets are doing very well, because small caps gives you best returns, but they're also extremely risky. Like when markets correct, small cap corrects also the most. So honestly, small caps from a return perspective is might you might feel get tempted to invest over there, but they're extremely volatile. Okay, extremely risky. But they also give you good returns from a long-term perspective. The problem is that our core portfolio, okay, it should be stable, good companies, large caps, followed by it's not that mid and small are not good companies. They are good, but they're more volatile. So mid is slightly more volatile, small is even more volatile. So a core portfolio should be large cap followed by mid and small. When should I switch from one fund to another fund? See, don't switch it for the sake of switching. You know what? Just have logged into an app कि कुछ करना है तो करने के लिए कर लो. Don't do that. Switch if there is a genuine reason. If you see that the AMC is the fund manager has changed, or the AMC you have lost trust in the AMC, or the fund manager has changed, or the philosophy of the fund has completely changed. Let that be a parameter. Ideally, select those funds which have got amazing history, good fund managers, amazing track record, and the funds who are consistent in their thought process. Okay, this is the funds ideally you will select. And once you select a fund, stay invested with the fund. Understand that there are certain funds, certain periods when they underperform the market, it's normal. And there are periods when they outperform the market, even that's normal. So stick with funds which have generated amazing amount of wealth from a long-term perspective. Stay with tried, tested, good funds from a long-term perspective. See, there is no hard and size. Siddhartha, your question is how much diversification is over diversification. There is no hard and fast rule to that. Uh, the idea is if you have only few funds, it's absolutely very concentrated. Uh, so everybody has different answers for that. I am more comfortable with 5 to 6 funds. This is how I have designed my portfolios. I know some people who are much more comfortable with 7, 8, 9 funds, and I also know some investors who are comfortable with 2 or 3 funds. There is no fixed formula. This is a very personal call which you have to take. How much diversification is comfortable for you? For me, 5 and 6 are for me. And I again say personal finance is more personal. For me, 5 and 6 gives me good comfort in terms of doing it. See, Prasad has asked a question that Cashless is promoting SIP top up in a big way. What is top up? Honestly, see, what is automation? Today, all my bills are basically through ECS. Okay, I don't even know what is my electricity bill, what is my gas bill, what is my society bill. all my insurance, all my SIPs, practically everything, all my credit card bills, everything happens through ECS. My salary comes through ECS online. I am not even, everything is automated. So what happens? It gives me amazing time in my life because everything is automated. I also know that my salary will increase every month, okay, or sorry, every year. So if I know my salary is going to increase by 10%, and if I automate that also by increasing my SIP amount by like 5% or 10%, okay, and I automate it, the beauty is that what happens is that I will be able to achieve my goals much more faster. So if I thought that by doing a 10,000 rupees SIP or a 20,000 rupees SIP, I'll be able to make this corpus at the age of 55. If I do a SIP top up, I'll be able to achieve that wealth much more faster. So basically, SIP top up is a very simple tool of achieving your goals faster, or if not faster, okay, helping you create more amount of wealth. It adds discipline to it. So if you have a predictable, if you know that if you can predict that your salary or your incomes are going to increase by this percentage, you can go for something called as SIP top. I would, Bharat have a question on technology fund. I would not recommend you honestly sector funds. Stay invested through diversified funds. They are the best option. Gold is a very good option. I would, yeah, silver is also funds are available, but I would recommend please invest into gold funds. That makes more sense. Silver has its own dynamics, and it can be also a good option if you believe in silver. But let gold be your core portfolio from a commodity perspective. Do an SIP into a gold fund. Yes, you can also do some amount of SIP into silver also, but let gold be your bigger amount in terms of doing SIP. Second is technology fund SIP. Yes, you can do it, but I'm bigger fan of doing funds in diversified fund, because what happens in sector funds, sometimes they give extremely good returns and sometimes they don't do well. It's quite possible that you might lose patience. If you're a new investor or with moderate experience, stay invested with diversified funds. Perfect. I don't see any other questions. Hiren, you want to take it forward from here?
Yeah, so thank you, Amit, for this wonderful insight on the SIP. It's a very important product for building your assets and growing your money. And at CashRich, we are the firm believer of that SIP is a wonderful instrument and it can help building portfolio in long term. So similarly, we also look at SIP top up as a a wonderful investment. So how basic SIP and how we can power it with a super or SIP top up, then how this SIP top up can help you, all our investors, in long term. So I'll just show you once a single slide which helps you understand the benefit of SIP top up. So if you see this slide, it is a very simple yet giving us a good insight. So like if you start with a basic SIP with an expected return of 12% over a period of 15 years, you achieve a goal of 50 lakhs. Now, if we just top it up every year by 2000, then you reduce your overall year of achieving your task by 4 years. So just by a simple top up exercise of 10%, 20% as per your requirement, you can achieve your goal faster. So start early and top up. This will give you a good perspective on how big your investment journey or how fast your journey can be. Similarly, if you look at if somebody starts an SIP today with 10,000, he can achieve in next 15 years is 50 lakhs. Now, if we delay it by say 3 years, your SIP amount which you need to contribute increases almost by 50%. And if you delay it by 5 years, your SIP amount increases again almost double. So the cost of delay is going to be very high. It's a very famous saying that early bird gets the worm. So this is a simple way of putting the perspective and making SIP as your best partner and one more earning member of your family. So that's it from my side. Over to you, Bhumika.
Thank you, Mr. Hiren. Thank you, Mr. Amit Grover, for taking a time out for this webinar. I also thank all the participants for attending this webinar. Wishing you all a great weekend ahead.
Thank you, everyone.
Thank you. Thank you. Bye.